If you invested £1,000 in 2016 in Revolut, as at 2021, your money will be valued around £571,000. Today, I'm going to be talking about another type of investing which is hardly ever talked about and is misconstrued as an investment for rich people. But you can do this type of investment with as little as £10 to £100, and this is angel investing. I'm going to share my personal experience as an angel investor to show you the potential that you as an individual could have being an angel investor, and also how much money you could possibly make. Then I will break down the video into 1. What angel investing is about. 2. Explain the different stages when a company can raise money. 3. How and when to know if your money is growing. 4. How to protect yourself from losing all your money. And 5. Examples of other companies that have made it and how much people could have made by investing in those companies through angel investing. Okay, so the first one, I'm going to talk about my personal experience. So in 2020, I invested in Moneybox. At that time, I had £1,000 to spare or to invest. So I bought about 286 shares, and the share price around that time was £3.5. Today, as it stands, the current value of my investments is $2,882. And the latest share price on paper is £10.08. So I've more than doubled my money since I invested in 2020. If you think of it, it's even better than some of the gains some of you guys have made in crypto. And this is investing in a company. So now let's dig into the world of angel investing. What is angel investing? Angel investing is when an individual invests their own money into an early stage business, usually a startup, in exchange for ownership or equity in that company. Think of it as this way. So someone has started a business, they've tested the business out in the market, they think that the business is going to work, and now they need money to move the business to the next level. So they come and ask people to invest little sums of money into their company in exchange for shares. So usually when the company comes in to raise money, they would have a valuation at the end of the round of raising money. So if, let's say, the full company is going to be valued at $1 million as at the time that they finish raising the funds they are looking to raise, then when they come again for another fundraising, which usually happens for most companies, then if the company is then valued at, let's say, $50 million, that means that your investment into one share of the company has gone up 50 times. So that is when you know how your investment is doing. And all this while you would be holding shares. So the way by which you can exit, or the way by which you can get your money back plus the gains you've made, is when the company allows you to sell. So whenever there is another fundraising, you can maybe sell the shares you have to the person who wants to buy it, and then you liquidate your investment in the company. So what are some of the key points in being an angel investor and why it is interesting? 1, you can invest small amounts of money. So we use platforms called Crowdcube and SEIS. I'm going to put the links on the screen. And most of these platforms is where you can go in and see which companies are trying to raise funds. And then you can look at their pitch or whatever they're trying to do. And if you like the idea or believe in their dream, then you can give them some of your money for the company to be able to get as much as they need to grow. One thing to note as well is that the angel investing space is quite illiquid. What does that mean? So the same way when I explained about ETFs, where you can buy and sell ETFs on the stock exchange, with angel investing, you are buying into a company. And so to be able to sell your stake, it needs to be through some transactions that are usually determined by the company. So that usually happens whenever the company is raising more money, not when you just feel like liquidating your investment. So your money could be tied up in there for about 10 years, about 3 years, about 7 years, and hasn't come out yet, or your money could even be lost. So it's quite illiquid, and also it's quite high risk. And also there are some tax benefits for investing in startups, especially here in the UK, which I will go into details in this video. Let's take you through the lifetime of a company. So the first stage is the pre-seed stage. In this stage, you have somebody who has an idea, or a group of people who have an idea, and they've not developed a product, they've not developed a service. They are looking to test out the idea in the market and see whether it works. Sometimes they don't have any money at all. So they'll go to maybe friends and family or people they know close by and say, hey, I've got this idea and I'm looking to test it out. Can you help me out? And some people will give them £100,000 just to test out the idea. In this case, they would give them money in exchange for shares, if that is what the agreement is. And when the business now moves to the next level where the product now exists in some form, they are beginning to see some traction, they can go and raise more funding. This stage is called the seed stage. The purpose of this stage is to get traction, to get the first users, early revenue coming in, or proof that the model actually works. Now, the next level after that is Series A. Series A is when the startup is gaining so much traction and it wants to scale to the next level. So at this point, you can have venture capital firms investing, or you can have it being listed on, or they're looking to raise funds on the platforms that I mentioned, Crowdcube or SEIS, and people can give them money to scale their company to the next level. Now, the next one after that is Series B. So now the company is growing really fast and wants to accelerate further. They go in for another level of funding, which is another amount of money that is pumped into the company. And in this case, they use that money to also scale the business to the next level. So the purpose here is to scale the operations, to enter new markets, and to develop new products. So in this case, it would be a company that's looking for tens of millions to be able to have more reach in their company. Then after that, you have Series C, Series D, Series E. So if it so happens that, let's say after Series B, they still need some investment, they can do more series, if I can put it that way, for them to be able to raise more money. Then the final stage is IPO, which means initial public offering. So initial public offering is when the company lists on the stock exchange. In that case, whoever has invested their money in the company, either pre-seed, seed, Series A, Series B, Series C, can now see the value of their shares on the stock exchange and be able to easily trade it, buy or sell on the stock exchange. By then, whatever you invested, if it went as planned, you will now see the value of your shares way higher than when you invested it. So let's say you bought some shares on Crowdcube of a particular company and you're wondering, is my shares growing? What is going to happen? How do I get my money back? I'll explain how this works. So when you invest in a company like that, let's take my Moneybox investments, for example. I have given the company money to put into their company to expand, to scale up. That money is not available to come back to me. But at some point in time, if the company says, okay, we are opening up to get some more funding, I can sell my shares to another investor who wants to buy. So the company itself doesn't give me money back, but because the company is functioning properly, then when it's growing, another investor can be interested. So let's say when I bought mine in 2020, they did other rounds and they would indicate in those rounds whether people who already own shares can sell their shares. And if so, you can go in and sell the shares and liquidate your investment. But if you think that you're going to stick with the company for the long term, you can keep your shares in the company. You may be earning some dividends if they decide to pay dividends. But as time goes on, they would have a long-term plan, mostly to IPO, so to get to initial public offering. And then you can know the value of your shares and easily trade it on the stock exchange. So on platforms like Crowdcube, the way I showed you with mine, they can show you on paper how much the company is valued. And in that case, you can determine how much you've gained on paper. So it's called unrealized gains. So when you see the unrealized gains, you can determine that, okay, according to them, this is how big their company has become. And if they were doing a round of funding now, I could try and exchange my shares for money with another investor who's looking to buy into the company. So that's how you can monitor your investment in Crowdcube, and I'm sure SEIS has a similar platform. Or you can see what the valuation of the company is, because I'm sure when you buy shares into a company, they will send you newsletters as a shareholder to tell you where they think they are valued at. And then you can use that to track to see whether your money is actually growing, whether it's stable, or whether the company is struggling and maybe you could be losing your money. Now, the next thing I'm going to talk about is how to protect yourself from losing all your money. Now, the first point is need to check whether the company is SEIS or EIS. So SEIS is a UK government scheme, full meaning Seed Enterprise Investment Scheme, which is designed to encourage investment in very early stage startups. Here's what you get if you invest in a company that qualifies for SEIS. 1, 50% income tax relief. So for instance, if you invest £1,000, you can claim back £500 off your income tax bill. 2, capital gains tax benefits. So if that company grows and you sell your shares for a profit, you might pay no capital gains on that profit. 3, downside protection. If the company unfortunately fails, you can claim loss relief, meaning a chunk of your loss can be offset by your tax bill. So in this case, you have some form of protection because you know that you cannot, if you are based in the UK and you are investing in a company that is SEIS, you are protected in some regard. So that helps you to not lose all your money if this company that you're investing in goes under. The other scheme that I wanted to talk about is the EIS scheme, which is Enterprise Investment Scheme. So the EIS is similar, but for slightly more established companies raising larger rounds. So you probably come across it where the company is raising probably Series B or Series C or maybe even Series A. The benefits aren't quite as big as SEIS, but still very generous. So what do you get? 1, 30% income tax relief. So if you invest £1,000, you can claim back £300 off your income tax. 2, capital gains benefits. Again, profits on your shares can be exempt from capital gains if you hold them long enough. And then 3, loss relief. So you can offset some of your losses against tax bill if things don't work out. The other way by which you can protect your investments is to invest in multiple companies. According to some insights and research, 90% of startups fail, which makes the type of investment very risky. Around 10% fail within the first year, 70% fail within the first 2 to 5 years. So in this case, when you're investing in startups, you really need to think about how to protect yourself. And one way by which you can protect yourself is by investing in several startups if this strategy is what you want to focus on. So for instance, in my case, I didn't just buy Moneybox. I did buy other companies that are not doing as well as that of Moneybox. But because I invested in Moneybox, I can show that as an example of one of the startups that's doing well. So if at that time I invested £10,000, my investment would have been valued around £28,000 by now. The last thing I want to talk about is give you an example of one of the startups that have done really well. And I know some people that invested in it and now they are looking at their valuations being way higher than what they invested in. And that company is Revolut. Revolut is such a crowdfunding success story. So they did a round of investments in 2016 on SEIS platform. They raised £1 million, and the valuation at that time was around £42 million after the money was raised. The share price around that time was £0.9 per share. Now, anyone could have invested. Everyday people could invest as little as £10 through SEIS to get equity in Revolut. By 2021, Revolut became Europe's most valuable fintech company. The valuation by 2021 was $33 billion, which is approximately £24 billion at that time. That's roughly 570 times increased valuation from when they raised funding in 2016. Let me put it in simple terms. If you invested £1,000 in 2016 in Revolut, as at 2021, your money will be valued around £571,000. Yes, more than $500,000 on paper. Now be mindful, Revolut is still a private company. I can't buy and sell those shares. And also, until they raise another set of funding or they go into IPO, I might not be able to liquidate my £1,000, which has now turned into £571,000 equivalent. But if I put my money in several companies, maybe £5,000 across about 5 companies, I will now have seen that one of them has way outperformed almost all the others that I invested. That is if some of all those others have actually gone under. So angel investing sits in the high risk investment bucket. You need to understand what you are investing in. So look at the company's pitch deck, look at it and determine for yourself whether you actually agree, you actually support, you actually are for whatever the company is looking to do and the potential that the company would have or the company might have, and decide that you are happy that if anything happens and you lose all your money, you will still be fine. I would not encourage putting all your money into angel investing platforms like Crowdfunding and SEIS because they are very high risk investments, but I will encourage having that as part of your investment portfolio as a way of diversifying in your investment journey. I hope you found this video helpful. I'm going to put a link for Crowdfunding and SEIS in my description. So if you want to check it out and see companies that come up there and are looking for investments, and if you want to analyze and see which ones you can spare some change for, then you can invest in some of these companies and then hopefully you can make some gains. But this will likely be a long-term strategy of investing and not a short-term one. Catch you later. It's been Abigail.